G'day guys, David Neradle here again from the Xylem. Hi guys, David again from the Xylem Zone. Just trying to get a bit of a connection there. Hope you've had a great day. Just finishing off mine down at Southport on the Gold Coast, and see those couple of towers behind. I've had a bit of a theme going on and talking about the cons of property investing, but this one's been more about off the plan and the mistakes that can happen. And today is mistake number 5, and it's all about how you can secure the deposit with an off the plan property. Obviously the first thing that most people think of is saving a cash deposit, and of course that's probably the safest way and best way to do it. But if your off the plan purchase isn't going to be completed for 2, 3, 4, 5 years, you may not want to have that type of cash tied up for that period of time. So there's some other things you need to consider, and other ways you can maybe secure a property to get that money, secure that property, and to have it tied up, and obviously not have to settle and get your lending till the property is completed. Now, some of these areas are certainly finance areas, so I'm not giving any financial advice here, and some of them have been used exclusively a lot in rising markets and need their own research done, and those two things are bank guarantees and deposit bonds. So there's two different ways. If you don't want to tie up your money, your cash for a long time, some banks you can go to and ask for a bank guarantee, and instead of having your cash tied up with the developer in a trust account, you can have it sitting in a bank earning interest, and the bank will give you a bank guarantee to say your funds are there, and you can deliver that to the developer in place of your deposit, and that means you're not tying up your cash. There's usually a 6 monthly fee and it rolls on. So obviously if it's going to be 5 years, bank guarantee is probably not good as a deposit bond, but if it's going to be a shorter term frame, a bank guarantee is definitely probably a better option and will cost you less. The other one's called a deposit bond, and they're provided by different insurance companies, and the difference with a deposit bond is you actually have to show equity. So if you've got a property that's $500,000, your deposit's $50,000, you've got to show 10% deposit, which is 50. The deposit bond company will often need you to show 3 to 5 times the amount of 50 in equity elsewhere in other property or cash, usually property. So and that asset has to be provided. You've got to provide the information for that asset. It has to be real, and even though it's not secured like a bank guarantee is, at the end of the day, if you do go and get a deposit bond, remember, if anything goes wrong, you've got to cough up, or the deposit bond company will deliver that $50,000 to the developer, and they'll come after you for the difference. And if you haven't been smart in the way you've done things, you can jeopardize the assets you put up to provide the security. So deposit bonds were very much the flavor of the month, probably 10 years ago when the property booms after the 2000. And the mistakes that people made is they went out and secured 1, 2, 3, even multiple properties with deposit bonds using the same equity, and never expecting to settle on the property. So that's an absolute no-no. You would never do that. It's absolute speculation, and you could really create a lot of risk. So hence you need to do your own advice, get your own advice from financial institutions, from brokers in regard to how these products work. But it could be a good alternative if you want to secure an asset without tying up your cash for a long time. And remember, if you understand your LVRs, sometimes you may be able to secure that property with only 5 or 10%, and later on, or you don't have to use the 20% up front, and you can secure it with a smaller amount of money now. So I suppose the con is, don't go and secure an asset if you don't have the capacity to settle. And if you're not sure about your financial position in the future, getting a long-term off the plan can be risky, because you need to have the ability to secure that loan and get that loan at the time when it settles in the future. And if you've lost a job, changed jobs, started a family, anything like that in the future, and you can't settle, again, you put your deposit on the line, and you put the asset on the line that you've helped put the equity up for if you use the deposit bond. So a few things to be careful of. It can be a useful tool if you know how to use it effectively. Not as many people and developers accept them these days, but they're still in the marketplace, to do your own research, and hopefully that's helped you with a bit of planning and avoiding some costly mistakes with off the plan. Have a great day, and this is David from the Xylem Zone signing off. See you soon.